Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
How's it going out there? It's November 20th. I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down the headlines and tell you what's really moving these markets. Holy cow, did you guys see the numbers for retail? And retail companies are reporting it's the end of earnings season, and they report towards the end of earnings season, but they all reported pretty much in the last 4 or 5 days. You have Macy's coming out tomorrow. It should be interesting. I would be surprised if that stock falls because it's gotten crushed so much going into the quarter, especially when we've seen recent results out there, especially from these big box retailers. As you know, I've followed this sector for a long time. Pretty good telling you when to buy it, when not to buy it. People always say the sector's dead, the mall is dead, these outlets are dead, and stores are closing. And they're right with the store closures, but you can't say it's dead. I mean, it's definitely an industry that's declined, but they're still trying to find their way, just like online companies and e-commerce, like 100% e-commerce sites. And we've even seen Amazon come on and Walmart come on and say that there's a big move into big box retailers because people just like to see things. They like to touch them, whether it's a TV or they want to try to close on. I mean, there's definitely a mix between that works. It's not either e-commerce or stores. People kind of want both. Of course, the e-commerce is much better, higher margin. You have to worry about paying as much employees, electricity, and stuff like that. But you're seeing it with these results, which are pretty insane. Right. I mean, if you're looking at specifically, Home Depot numbers are pretty bad. I was surprised. I mean, the stock fell more than 5% of the news, which it's not really that bad. The stock's up tremendous, 35% year to date heading into the quarter, up about 15% over the last 3 months. And now it's declined, but the numbers really weren't that good. Where you saw margins fall, net earnings were down 3% year over year, and Home Depot trades at a very high multiple, right? And you're looking at earnings declining year over year. And that premium is around 20 times forward earnings. The rest of the market trades around 17 times earnings. But what was really disappointing with Home Depot is the communication, because it was a couple of weeks ago, I believe, that they spoke at the Goldman Investor Conference, right? It's a very, very big conference. And when they were doing this presentation, I think it was either the CEO, someone high profile, might not have been the CEO, but they actually said the U.S. consumer is exceptionally healthy right now. And it was a headline. I've seen the headlines in different places. Home Depot says the consumer, because that's the big thing, right? Is the consumer good? Are they okay? And consumer spending accounts for 75% of GDP. So, it's amazing that one of the biggest retailers in the world came out and said that. And it's even more amazing that was a few weeks ago. And then you come around and you report these numbers and kind of weak guidance. That was surprising. Now, these weak Home Depot numbers, they're echoed by Kohl's, which was a horrible quarter, and guidance. The stock fell 20% in one day. Kohl's fell 20% in one day. And they missed earnings by a ton. Guidance was incredibly weak. And it's funny because when I dug into those details, their strategy is, hey, we need to increase their e-commerce platform where, people buy online and pick up in the store, right? That's the big advantage you have if you have big box retailers, right? You can look, shop, and say, okay, now I can go to the store and pick it up instead of getting it shipped, whatever. Now, they also sign a partnership with Amazon that allows Amazon customers to return their merchandise at Kohl's stores. This has resulted in an increase of traffic, which they said on their call. But it's crushing them, and this strategy is backfiring for them because it's not leading to more spending by the consumer. So you're looking at that, and what's happening, and it's not just Urban Outfitters reported, again, another company that bombed the quarter in the retail industry, and what's happening in this sector is companies are trying to increase traffic any way possible, right? That's what you want to do. And that's not a great thing. Hear me out first. If you're spending $100 per customer to increase that traffic, and these customers are only buying $75 in merchandise, and that's what's going on. Not exactly those numbers, but you get my point. So what does that result in? Results in higher sales, but lower margins. And that's where these guys get smoked, especially the smaller ones. Because you're looking at Amazon and Walmart, they know these trends. That's why they're spending a fortune on the one-day shipping, which is increased expenses for these two giants. But if you're looking at the long-term outlook, it crushes the competition, which can't really compete with something like that. They try, but they don't have the balance sheets of the Amazons and the Walmarts to do something like this, to take a hit, to see, Amazon stock decline by 5-7% because, hey, we're putting more money into it because we're going to do one-day shipping, which separates them from almost everyone out there. And Walmart followed suit, but look at the other companies. They can't really follow that. That's tough to do. So when I'm looking at holiday sales, and the reason why I'm starting out this segment, right? So going into holiday sales, this is Black Friday just around the corner, Cyber Monday. I don't think you're going to see a lot of winners in terms of stocks. You look at Kohl's, Nordstrom, Gap, Guess, Urban Outfitters, just a ton of risk in a lot of these names. And I'm not sure the reward is worth that risk you're going to take, even though some of these names have already gotten crushed. So for me, when I look at this sector, it's not a good idea to go bottom fishing into the holiday season where margins are going to be incredibly weak. I shared a story with you once before when I was working with Jim Cramer, and we had a big Christmas party when things were great. Eddie Lampert was there. He was a close friend of Jim's. And I was talking to him through our CEO, and he said, holiday sales, the worst. It's the worst. And Eddie Lampert is Sears, right? And we know what happened to Sears, but this is probably about 12, 15 years ago. And he said it's the worst. It's the worst ever. It's the holiday set. It's the worst period. We discount everything. The customers bring back a lot of stuff. It's you don't make a lot of money on it, but you have to offer it because everyone else is offering it, and you're going to lose out. So when I see everything here and everybody that reported so far, there's a much bigger point here that you need to understand as an investor. So the weakness in some of these retailers, it's not a reflection of the consumer. I know it might sound crazy. I also know what I just said is pretty boring, right? Everybody wants to hear that crash and burn story. The world is ending. The consumer is dead. Stores are going to close. That gets headlines. I get it. But it's not the case because what do we see? Target. Target's expectations, right? With that stock of where it ran up through $100, and this is something I was wrong on. I told you I avoided a while ago. Holy cow, was I wrong? They got everything right. It's rare that you see Target and Walmart both move up in tandem because usually they go through these periods where Walmart wants to be Target and offer a little bit more high-end products, and Target wants to be Walmart. They want to say, hey, let's offer discount products. Both of these guys are making it work at the same time, which is cool. But Target had huge expectations, and they blew them out. They blew out those expectations, and that stock went higher. Walmart, good quarter. Best Buy, near an all-time high. They figured it out. They figured out how to compete. Now they have partnerships with Amazon. Where people used to go to Best Buy and say, wow, this is pretty cool. Okay, let me go to Amazon. Now they match prices. Now you can go to the store and get your TV, your flat screen TV. Plus, they offer their whole Geek Squad services division, which comes and sets the whole thing up. And that's like pure margins, which is great. And that's how they compete and say, this is what we're going to do. We'll match the prices, but they're going to make it up on the services end. And yet they have that advantage where if you buy a flat screen TV on Amazon, you can't really touch it. Not you can't. You can't touch it, right? Maybe go sample it in other stores, but why am I going to even go on Amazon when I can go there, ask the person a question? He knows everything about that product. You're not going to Walmart and asking them a question about technology where they're going to give you the box and read it and tell you what it is, right? Nobody knows what's going on in those stores. That's why they offer discounts. These guys are specialized and tell you everything about the TV, what's good. This might be a better option. It could be cheaper, more expensive. Yeah, people love that. Finding ways to compete. Amazon doing a great job. You look at Dollar General, eBay. So what does this mean? It's something that I told you about 4 or 5 months ago that I'm seeing in the market for the first time in a good 5-6 years. You're seeing separation from the garbage to the good stuff. Okay, over the years, this bull market has been running higher, but we've seen all the technology stocks do great. All of a sudden now, even you're seeing some technology stocks sell off and others do well within the chip sector. Applied Materials, not good. Intel was really good. There's, Micron, okay, but there's separation between these names. Some of them, again, just are not getting it done. So it's not the whole industry or a cyclical thing. It's companies and management teams. Some of them are doing a great job and others are not. And you know what? That means it's a stock picker's market. That's something I love, that I pride myself on. Where you're going to find the best ideas within the market where in the past, you would say, okay, here's my top-down approach. I'm going to invest in whatever it is, whatever sector. Say if it's healthcare. All right, I do like healthcare. Healthcare is cool. I'm going to invest in it. And I think healthcare is going to take off. So what is my job? My job is pretty much to buy the most risky companies because those are the ones that go up the most in a full blown out bull market. Just like those are the ones that go down the most when the market crashes. But now you can't do that. Those stocks aren't really participating in that move up. Not all the stocks. Look at retail. Target's through the roof. Target's amazing. Walmart, Dollar General. Lowe's reported decent numbers when Home Depot didn't. And yet you're seeing all the bad reports out there where Kohl's, Urban Outfitters, a lot of separation. So it's not the whole industry where the consumer is doing bad. You're going to hear that a lot out there. I want you to ignore all those headlines. It's a great headline. Consumer is dead. Retail's dead. All this stuff's dead. Retail's not dead. Big box is not dead, or there would be no Best Buy. There would be no Walmart. It's not. There's just people who are getting it done and management teams that are getting it done and management teams that are not getting it done and they haven't figured it out yet. And that provides a great opportunity for you to really sift through these ideas individually to find out which are the best plays. So with this intro, it's more about looking at the consumer, looking at sentiment. The consumer is spending. They're spending. If you look at the retail sales number last month, it was pretty strong, showing that spending on, not just spending, but on discretionary items is going higher. You're looking at e-commerce is through the roof. You're looking at certain supplies are through the roof. There's certain areas and pockets that are doing well, and what's not doing well, kind of like clothing, apparel, building materials, not doing so well. So there is separation to find new ideas, and that's what my educational segment's going to be about. Okay, I'll get to that in a minute because I want to move on and tell you that I have a great interview set up for you today. It's with first-time guest, Genia Turanova. So Genia is our newest hire at Curzio Research, new editor of Moneyflow Trader. It's a credible analyst, very, very smart. You'll see in a minute. 15 years experience in option trading, also in income investing, incredible track record. And I was just blown away when I spoke with her about a methodology of how she finds stocks that overlap with a lot of stuff that I look at. And I was just really impressed right off the bat. And then seeing her gains and experience, I just thought she'd be an amazing fit, and she's been doing a fantastic job right now. So she's going to talk about her methodology for finding her best stock ideas. She's going to give you a great lesson on how to invest in income securities. Please listen to that part. It's very important because people just like to buy the highest yielding stocks without them growing, and they get killed. Even though, hey, I got a 5% yield, your stock's down 20%. Okay, doesn't make sense, right? That 5% yield. She's going to break down some of the ways of great lessons of how to invest in those income securities. And also, she's going to share some of her favorite ideas with us. Really great interview coming up. Then my educational segment. I just mentioned in the intro probably about 15 stocks, but get your pen and paper out because I'm going to mention at least another 20 stocks. That's what I'm going to do for you because I'm a nice guy. Now, these stocks are based on the latest 13F filings, which is basically a document that must be filed every quarter. And this is from equity portfolio managers who manage over 100 million assets. They have to tell the world, hey, this is what I'm buying, selling. In the filing, they basically disclose all the names that are currently in the portfolio, including new positions that they're adding to, positions that they lowered, and also the positions that they completely sold out of. Now, when you look at this is, a lot of these companies, and I'll go over this in the educational segment, but, there's ways to look at this where you don't just say, wow, Warren Buffett bought this or somebody bought this, because they might not own it. This is reported 2 weeks ago, and they may have built that position over the month. But if you're looking at a company like Renaissance Technology, Six Sigma, they're in and out of hundreds of stocks in minutes. So when you're reporting this, a lot of these stocks, they don't own anymore. With that said, when you have managers that have passive strategies that buy and hold, they're going to add to these positions over a long period. And it's the best way for me to find new ideas. Not that I'm going to say, okay, David Tepper bought this, I'm going to go buy it. No, it's something where, wow, why are you buying this, which has gotten crushed? Or here's a small cap name that a big fund manager is buying, and I'll start doing the research on it. And that's what this process is about, starting your research on the 20 or so names I'm about to give you. Because maybe one of them drops 10, 15%. I know David Tepper just started a new position. He's going to be adding to it. Maybe it gives you a good opportunity to buy it. But I'm going to show you exactly how I'm finding new ideas. The 13Fs get released after pretty much earnings season, which is like right now. And again, outlines all the holdings of these, what they're buying, what they're selling. And I'm going to tell you what some of these ideas that they have in their portfolios just are pretty crazy. And by crazy, I'd say just interesting, where I'm like, wow, this doesn't make sense of why this person would buy it when, on TV, maybe they're saying they don't like this industry. Or maybe they just sold out of a position that everybody likes and it's a really big fund manager. But I'm going to show you exactly how to find the best ideas to start the research process. And again, get your pen and paper out because there's a lot of these names. You could find them by yourself. You can go through Google, but I'm going to break down some of the top managers, what they own, and you're going to get lots of new ideas to research from this segment. But first, let's get to my interview with Genia Turanova, where she's also going to share a lot of pretty cool ideas with you, including a few income names. You know what? Let's get to that interview right now. Genia Turanova, thanks so much for joining us on Wall Street Unplugged.
Hi, happy to be here.
Well, you're a first-time guest, newest member to our research team, including editor of Moneyflow Trader. And you know what? Let's start with this. Let's give everyone a little background about how you got into the financial newsletter industry. And you also manage money and have 15 years of experience. But why don't you get everyone on the same page since this is the first time you're on the show?
Oh yeah, sure. I liked finance. I liked my money management. I like stocks a lot. So my first job out of college was actually a continuation of my internships. I worked for a little bit for a small money manager in New York City, and that focus was mostly on ETFs. My next job was more stock related, and that's where I worked for about 15 years or so. And the same company that I worked as a portfolio manager, same company had a second business of writing newsletters. So that's how I got started back in 2003.
So what impressed me the most is when the first time I spoke with you, we were talking about your methodology of finding new ideas. And I was kind of blown away because it overlapped with a lot of things I look at. And, I have these lessons in this podcast and educational segment, and a lot of stuff that you were saying, like different investment styles and learn from the market. It really impressed me. Could you talk about your methodology for finding stocks? Because, everybody has their own way of doing things, and some people just set in their ways and other people, you need to adapt. But just maybe if you could talk a little bit about that, this way people get a good perspective of, how hard you work and the research that goes into everything that you're producing for us and what you produce over the past 15 years.
All right. So I do have almost 2 decades of experience in this business, and I was taught to approach stock investing from a slightly different way, in a slightly different way that most people that I know do. I start with the looking at the economic trends, macroeconomy, large significant changes that's expected, or something that's really been going on and maybe incorporated in your long-term outlook. It's called the top-bottom research, and it's really where you should be getting started if you want to invest efficiently. The benefit of this approach is really getting you a wide range of choices. And at the same time, if you understand what's going on with the economy, the market, and the overall technology, and there's some other long-term important trends, you can actually figure out what is next for the market. You want, as a growth and even income investor, you want businesses that are poised to grow, not to die. And so you would like to invest in sectors that are poised to grow as well. That's pretty much the first step in the approach that I've learned to do. And the second step is your traditional stock research. So you start with the bird's eye view, so to speak. Then you go down by sector. Then you select your preferred area, and then you go in and study everything that you can about your best position stocks. That usually gives results.
Now, I love that you took us through that path because I want to give an example here. When you mentioned something interesting when you said income, but you want to invest in income with companies that are growing. And I think a lot of times, especially with amateur investors out there, they see a company, they see a 3% yield and say it's paying higher than the S&P, which is whatever, around 2%, or they'll see a 4 or 5% yield on a REIT or a mass limited partnership. And income is an area that you cover closely. How important is that? And maybe what are some of the areas, whether it's, when you're looking from the top down approach, where I would think, healthcare looks really attractive right now. Technology looks really attractive right now, to the point where now I could filter it down and find the right investments. But talk about the income portion of it, which, Ginny, as well as I do, the whole world, right? The whole world wants income because interest rates are going lower and lower and lower. We have negative interest rates. And this is the question I get the most. And this is why we're launching a product around you in a few months. But talk about maybe some of the areas and maybe a couple of ideas for income, because I think people are misled sometimes just looking at the yield and not looking at the actual company and its growth potential, which it's important.
It is important. And it's as important for income investor as it is for a growth investor. You may not want a 40% growth. You may not want a 20% growth. And, honestly, you won't really get a significant or any income with the 40% growers. But you do want a company to grow. You buy, it's the basics over any investment. Whether you buy in a corner grocery store or consider buying a corner grocery store, or you buy in a stock, you buy future business. You don't buy, and you shouldn't really care of what was happening with this business a year ago, 5 years ago, or maybe even yesterday. You want to know what will be happening tomorrow, a year out, a few years out. If you're really lucky, what's going to happen a decade out. So you want something for income that can sustain a dividend. And you also want something that can pay a dividend that's growing, pay a dividend that will eventually support your investment in case the market turns south. And you also want something that will give you at least some price appreciation, which is something you will get from growing, not declining companies. That's why you really shouldn't be looking at just the yield number. And if you do, you want to try to avoid companies that yield much more than their peers. That usually is a red flag.
Now, you see some of these red flags, and I know that you always say and be careful with mortgage REITs, also be careful with closed-end funds, because you follow this. And, for you, when it comes to income, this isn't you saying, okay, here's some blue chip stocks. You have gone anywhere you think is a good risk reward for income, closed-end funds, bonds, and this is going to be a unique newsletter around that. It's not just simple, hey, here's a couple blue chips that you could find on your own. And my question is, what do you see or some of the red flags in things like mortgage REITs or maybe closed-end funds that the average investor might see and see a high yield and be like, wow, this is cool, but sometimes they don't really look under the hood? What are some of the things that they can look at to basically level them out and make sure that they're not making a mistake?
Well, mortgage REITs is a very interesting area. It's a part of a REIT sector that really is not a part of the REIT sector, as was decided a couple of years ago when REITs were selected to form a new S&P 500 sector. REITs, your normal REIT, like your storage REIT or mall REIT or data REIT, would go into the new sector, and all the mortgage REITs stayed within the financial sector. That's because they're really financial securities, and what they do, they invest in mortgages. As easy as that. That's why they're called mortgage REITs. Because they do invest in mortgages, they're extremely sensitive to interest rate changes. When interest rates were on the rise, mortgage REITs really took it on the chin. And this year, because as you know, rates were declining, the mortgage rates did relatively okay. It's just something that you need to be aware of, the sensitivity to interest rate level and direction. And as good the yield might look, mortgage rates rarely go up in price. They fluctuate, but their share price won't let you capitalize on the increase. So you want to have maybe some income in mortgage rates, but you really don't want to go all out.
Okay. And when you look at things like closed-end funds, actually, this is a fascinating industry. I don't know if anyone knows this, but my dad, when he used to write a newsletter, had a special section, and this was like 20 years ago, 25 years ago, where it was just closed-end funds. A lot of them are closed-end bond funds. You don't hear about closed-end funds at all these days, right? Especially from the millennial generation. I bet you a lot of them don't even know what a closed-end fund is, where it's just, it's not a mutual fund. It's a bunch of stocks together or bonds, and it trades like a stock. You can just put in the symbol and buy it. Talk about that, because that's a great place to find yield. My dad lived off of those, where he had income investors for decades. But why is it that's like people don't talk about closed-end funds anymore? You don't see them anywhere.
I think what might have happened is that their ETFs won. It's also a diversified investment. It's easy to understand the ETF, and it's really inexpensive to invest. It may not get you the yield, but you understand what's in it. You can buy and sell, and the ETFs that we have for right now. I think we have more ETFs than we have the stocks in the universe, in the U.S. market universe. Closed-end funds are different. Closed-end funds are closed, black box. It's what it is. The essential black box securities. You don't know exactly quarter from quarter what kind of trading goes on within the fund. They're leveraged, so people get scared of the leverage. And it's possibly also because they're relatively difficult to understand. There have been a decline in the popularity of some closed-end funds merged, and not too many new closed funds have been created. So this is all is the answer to why closed-end funds may not be as popular. There are just not too many of them, and the income investors know they do exist, but the funds, I don't believe they even advertise. And if they do, some past performance, like the 2009 decline, they really hurt the entire industry. And what happened back then was that the leverage worked against the funds and their investors. Closed-end funds are leveraged, which means they invest in their securities. They also take out loans, and some of the securities are bought on imagine they bought it. They take a loan and buy security on loan. So they have to pay the interest costs, and any gain is magnified and any loss is magnified because of the leverage. You want to do, just like with mortgage REITs, you want to do closed-end funds in moderation. But the moderation doesn't mean that you have to avoid them. The yield is unlike anything else in the relatively safe part of the market. You can get 6, 7, 8% yield from a closed-end fund, and you'll get it with a little less risk now that interest rates are relatively low. Another issue with the closed-end funds is that some of their distributions, and for many funds, much of their distribution is classified as capital gain. It's a problem because in some way they pay you back your own money, but it's not as bad because if you own a closed-end fund in a taxable account, they have generally speaking, they have a good positive implication for your cost basis. Of course, just like with any tax advice, you have to talk to your investment professional, tax professional, but return of capital is somewhat positive in this regard.
And I love the fact you say, but disclaimer part, right? You talk to your tax person, you can tell you manage money, right?
Well,
just make sure you
taxes. You really want to be very careful about your tax situation.
Of course. So now you were telling me two places where you're spotting income right now. And again, we went down to, your top-down approach. You're looking at different areas that are doing well, economically, and then filter it down to different sectors and stocks. And two of those things that you've mentioned to me are technology, right, which people, and also telecom, right? So these are two areas where you're seeing income. Talk about it a little bit, maybe if you can share a couple of ideas, which my audience always loves. But maybe now they're going to see the full process, guys. We're seeing Genia's methodology, how she comes down, filter it down to sectors. Now let's get to the actual stocks and things that you like.
Yeah, sure. Technology is a very interesting income sector because so many technology stocks now are flash with cash, and they don't grow as fast even as they used to, even though they do still grow. So that's what I like about the sector, moderate but steady growth. And many of them yield at least as much as the S&P 500 with the possibility of dividend increases. Again, check that box. We like companies that can grow company that can grow dividends. Cisco Systems, a dominant network company, that now yields 3.1%. That yield is safe. That yield is secure. That yield is poised to grow. And Cisco is as safe as it comes in terms of their business. It may not last forever. Right now, it is a dominant network security company. They have too much business to grow double digits, and maybe they're too big to outperform the market. But as an income stock, Cisco is perfectly fine.
And
moreover,
you also like it, and Jenny, you like it like now, right? Because we just saw Cisco a couple of days ago, maybe a week ago, report bad earnings where it came down. So it's not like, hey, Cisco was one of your picks a long time ago. This is now because it came down, right?
Exactly. That's what happened a few days ago. Cisco shares declined more than 7% in just a single day. In terms of market value, I think it's about $15 billion in market value just gone in one day. The stock has recovered about $1, maybe a little less since then. But that's where the buying opportunity comes from. When the safe and secure income investment declines for good maybe reason, but that long term nothing's really changed. And what is interesting about Cisco is I think they're one of the best security companies you can invest in, especially if you want income. You want exposure to growth areas, which is networking. And within networking, Cisco is getting very strong with the software and internet security. About a year ago, they bought a security company, and for $2.4 billion, they bought the cybersecurity company deal. And the latest quarter, the quarter after which the shares declined, its security business was up 22%. It's a very interesting stock, gives you a nice yield, and the yield is not going anywhere.
Now, one more idea before I let you go, because I know you said telecoms, which, a lot of people consider telecoms like AT&T and Verizon. I've been a big fan of AT&T for a long time, gotten a lot of heat from it. but also Verizon too. What are some of those are two names you're talking about with telecom? Because I know the income they provide is much greater than the the average income for the S&P 500.
I think you want to have, as an income investor, you want to have both, because you don't know which one is going to do better price-wise. And the AT&T, you may have gotten the hit for it, but it's not the AT&T we used to know. Now they own Time Warner. It's becoming a media company, and I think they will survive through the growing pains, and it will be a steady business that would combine, as it is now, the strength of both worlds. Another company that is a combination of telecommunication services and media is Comcast. And I think Comcast is something to look at if you want dividend growth. Verizon and AT&T, they raise dividends for about 2% a quarter, or a year, sorry about that, and a penny a year. Comcast dividend growth rate is about 10%. It's an expensive stock. It doesn't yield as much, but that yield is growing. And Comcast owns NBC Universal after a merger a few years ago, and they now bought their Sky, another entertainment company, and their business is a combination of the two strongest income yielding businesses. So I think Comcast is something to look at.
Well, I mean, that's great. So three great ideas. And guys, the reason why I'm talking to Genia about this is because I've been listening to you. We send out surveys to you all the time and asking you what you want, because we're in a position where, we know a lot of people do want to write financial newsletters. But one of the biggest demands was, could we find a good income newsletter? And this is what Genia is going to launch for us in a couple of months, which we're really excited about. Right now, she's at our Moneyflow Trader. What we're really excited about is just, it's not going to be the typical blue chip. It's going to be something that you're going to educate people on, like you educate us today, where, listen, you got to look at the growth of the company, not just the dividend yield. I think a lot of people make that mistake, but also it's not just going to be these blue chip companies. It's going to be a whole host of ideas where you'll go anywhere with this product, and we're looking forward to launching this. So I really appreciate your time. I know how busy you are, since today your issue goes out for Moneyflow Trader, which you're excited about. But I really appreciate you taking the time to join us, and I'm definitely going to have you on a lot more after this as well. And guys, if you have any questions, feel free to email me, Curzioresearch.com. But Genia, thank you so much for coming on. I really appreciate it.
Thank you. My pleasure.
You guys, great stuff from Genia. And don't be fooled by the accent, the calm nature. She is an unbelievable analyst. The details that she looks at to find her recommendations. I've talked to her through that process as well. We shared research and things. And it's pretty remarkable how much detail goes into her research. Not only that, she's been doing it for a long time, has a great track record. What I love about Genia is she's just such a real person. So this is the first time she came on. We hired her not long ago. And after it, she's like, I just wish, I was a little nervous. And I understand that, right? Because this is going out to so many people. And when I was at Stansberry, when they first hired me, there's a lot of analysts that you guys know, whether it's Doc and Dan Ferris and Steve Sugar and all those guys, great people, Doc, Eifrig. And, Porter Stansberry asked me when I was there for a week before I even launched my newsletter and said, hey, we have this big conference. We call it the Alliance Conference. And you know what? I want you to speak at it. And I have to tell you, I was nervous because I didn't meet the guys yet. I didn't meet the crew, right? I wasn't part of the family yet. And for her to come on this soon and just go through everything, and show and actually say, wow, I was just a little bit nervous. It shows that she cares. It shows that, and you could see that where, she's now the editor of Moneyflow Trader. She took over, and the amount of alerts that you're getting, the research that you're getting, the educational component. Notice how she broke down a lot of stuff for you, which I love. I mean, some people know what leverage is, but I love the fact that, we're talking to a whole audience. So she broke down exactly what leverage is. And that's the sign of a good newsletter writer. Because you're a newsletter writer, and you have to be able to not just give recommendations, but you have to be able to educate your audience, your clients, your subscribers, right? And to do that, it's not easy sometimes to explain a biotech company or explain leverages The best analysts in the industry do that. They know how to simplify things and explain things. This way you understand why they're recommending that stock, which is important. Because now it's not just you getting a stock and saying, hey, okay, I got the stock, I'm going to buy it. If it goes down, you yell at us. If it goes higher, you're probably not going to email us, which is fun. That's our job. You're paying us to make you money. And I get it. But Genia's approach and just her experience, it just really impressed the hell out of me. And just, she's a humble person. She's never, hey, I know this and I'm great and all this. I love the fact that it's nonstop with her. And I just saw a lot of what I do with my methodology and what she does, where we're always learning. I mean, here I am trying to teach it from the mistakes I made, but we're always learning new things. This is a brand new market. Low interest rates like this is brand new. It's never happened in the history of the world. It's a different market. Totally different. There's a lot of different crazy things going on. The president influencing the Fed and tweeting. There's so many different things, and just being able to look at and learn and get better. That's one of the things I love about her. So let me know what you thought about that interview. Frank at CurzioResearch.com, and she is going to be launching that new income newsletter for us in Q1, which we're very, very excited about. And you're going to see pretty much one of the best income products out there. This is the type of product I wanted to create, not something I'm just going to give you blue chips and charge you money for it. No, you can find those stocks anyway. You can go into the Dividend Aristocrats and look them up and buy a bunch of those. You don't need to subscribe to anybody. This is going to be unique ideas, going through the closed-end bond funds, going into technology stocks that got wrecked, going into maybe bonds, different things that you could buy for income, which all of us are in dire need of, right? With low interest rates, you get nothing in the bank, CDs, treasuries, everybody's dying for yield out there. And Genia's going to show you exactly how to find the best yield from the best risk reward perspective. So I'm looking forward to that. Again, let me know what you thought of the interview, Frank at CurzioResearch.com. Let's move on here to my educational segment, which is going to be pretty fun because this is about 13 Fs. And every quarter, you have fund managers, hedge fund managers, anyone that manages more than $100 million in equity assets, I should say, must disclose their equity holdings. Right? And this is every single quarter. This includes new positions, increase in current positions, a decrease in the current positions, and positions they close out of. Now, this data is calculated after the quarter ends, which is about 2 weeks before they report, around 2 weeks. So you're getting this data, and you can say, well, it's a little bit lagging. What does this mean that I'm getting in 2 weeks? It means these fund managers could have sold out of their positions by the time you read it. That could happen. Now, it's not the case for most of them. I'd say more than 80, 85%, like the icons, the Buffetts, David Tepper, Dan Loebs, Ackman, who are not just short-term investors getting in and out of situations right away, right? But it is the case for companies like Six Sigma, Renaissance Technologies, who also have to report, but they use algorithmic trading. They don't look at fundamentals or anything, and they're getting in and out of stocks, hundreds of them per day sometimes. So I wouldn't look at the 13F for Renaissance or some of these other platforms that have algorithmic trading, right? Because it doesn't really make sense. A lot of those stocks might not be in those holdings. So putting it all together, data is less relevant from a fund that's active, right? Or trades a lot compared to one that's passive. That's how they describe passive or active when they take positions in these. And you like to see passive. That means they're not getting in and out of the situation. And chances are, if David Tepper takes a position in a stock, he's going to be adding to that position, over time, right? And that's what you want to see. Now, with that said, there's a couple of things where this is a whole insider thing that I realize, I'm going to cover a lot of stuff here and start with Value Act. So Value Act is a very, very large fund, very prestigious. They're buying, as of last quarter, PG&E Corp, which is kind of crazy. And I don't have a big position around 10 million, which is not a lot for them, but surprising given all the risks, right? I'm pretty sure PG&E is still in bankruptcy. So I don't know how that figures out. I'm just curious that they bought this stock, right? It's just kind of weird that they see value in it because, the wildfires and they've been, I think, not accused, but I think it's proven that a lot of their equipment, again, I don't want to say it's not true, but from what I'm reading, and this is this place where I'm starting out with, but, a lot of these fires were caused by faulty equipment that they made. I know they did file for bankruptcy. I don't know if they came out of it, but they restructured their debt. They're looking to do lots of different things. A lot of these companies come out of bankruptcy and go through the roof. We've seen it happen. General Growth Properties is one name that comes to mind. But the company, when you look under the hood, has some incredible assets. I know about all the risks, but they have a huge position in nuclear, hydro, solar, amazing assets there. It's probably why they're able to get the restructuring done, the bankruptcy and stuff like that. Bankruptcy doesn't mean you go out of business. It just gives you time to pay your creditors back and restructure your debt, and hopefully you can come back out of bankruptcy, right? Depends how you're filing Chapter 7, Chapter 11. So bankruptcy doesn't mean you're out of business. But that's a surprising name to me, Value Act. Elliott Management, right? They would talk about AT&T. They did take a big position in AT&T, 3 million shares. This is Paul Singer. Big position since AT&T was at a 52-week high. It's a little bit off, got like a downgrade here and there. People worried about their subscription DirecTV customers, but nobody talks about their subscriptions to internet, which are much higher margins. So yes, everyone knows that they're going to lose a lot of DirecTV, especially with everything going on with Disney Plus and all these streaming services. That's fine. AT&T is going to have their own streaming service, but you can't just say they're going to lose subscribers without saying the subscribers are gaining because they laid fiber underneath everyone's nose, every place almost, where those people pay a lot more money, the average price, compared to the DirecTV subscriptions. And they're adding. That's why you're looking at a company with average revenue per subscriber is going higher, even though they're losing DirecTV customers. Nobody's going to tell you that full story. So somebody downgraded the stock. It's off 5% from its highs. But that's interesting to me. You're taking that position at AT&T at these levels. I mean, this is a company that's been pitching below 30. Now pushed to 40 almost, around 37, 38. So buying at this level, it's a pretty big endorsement. I noticed just as an insider buy where there was a director that just came onto Intel, a very prestigious director. I think it was about 3-4 days ago. And what did he do? He turned around and purchased $5 million worth of Intel. $5 million. I mean, Intel's trading here at 20-year high. That's one of the things I look at that is an eye-opener. It's not just insider buy. I love to see when stocks get crushed and the insiders come in and buy, right? That's cool. It kind of gives you like that bottom feeling. These guys are buying it here. If it goes lower, they might buy more. When you have insiders buying stocks at 52-week highs, that is like the ultimate bullish sign. And $5 million is a lot of money for an individual purchase. Not a lot for funds, which you also see on insiders if they own more than 10% of the stock. But for an actual person to buy that much of Intel, it's just, again, another big endorsement. Going down a list, if you look at Elliott Management, an interesting new position. Again, get your pen and paper, Zach, guys. I'm going to give you a lot of cool stocks that I want you to start researching. But Carbonite is a company that has less than $1 billion market cap. These large funds usually purchase, again, they want that liquidity and they take these big positions in $10 billion, $100 billion, now $1 trillion companies, right? With Intel and not Intel. Hopefully Intel, because it's one of my largest holdings and it's also in my newsletter. We're doing well on it, but with Microsoft, which is $1 trillion market cap, and also Apple. But when you look at Carbonite, it's a tech company that's kind of like cybersecurity, provides backup, disaster recovery, protects data for customers, which is a monster business, right? Macy's is the latest to say that their credit cards, that data's got compromised. We hear that all the time. So these guys' business is pretty good. And after this purchase, when, obviously this 13F got published and probably about a week ago, the stock did pop from around $15 to $22, but that's because the company got nailed. I mean, if you're looking from it's not even a year ago, you look at a high of $42 and it fell to 15. So for me, when I look at this and I see a value investor picking this up, or, Elliott Management, Paul Singer picking this up, I want to find out why this company fell so much. What's going on? Can they reverse that trend? Because you're going to gain all that right back. When the stock was 42, it's still at 22. So I want to see what's going on with this company. Why did it fall so bad and become out of favor? But now it's nice to see, and that's why you see this thing pop from 15 to 22. Kind of like Cloudera when Icon took a position in that. When you see these companies get destroyed and a big name comes in, people feel it's the bottom and they try to piggyback. But that's a name that you're not going to hear of a lot. But Carbonite is one that he invested in. I want to do more research on it. Doesn't mean I'm going to buy it. Maybe it falls 15% after the next quarter, and I could be like, wow, now I could buy it at a really good price, which is not only a 50, 60% discount to where it was trading not long ago, but also a 15% discount to Elliott Management, which I know, since they just took a new position in this, they're probably going to continue to add going forward. Going to keep going here. Again, I told you, lots of stock ideas. You don't get this on another podcast. Lots and lots of ideas. Glenview Capital, Larry Robbins bought Newell. Newell was a disaster, right? It was over 50 in 2017, now into 20. And they established a new position in the name with, 2 million share purchase. What's going on there? These businesses, especially brand name businesses, don't stay down forever. Most of them, every one of them, doing this for over 25 years. All these businesses go through ups and downs. Every one of them. You look at McDonald's, you look at AT&T, look at Apple, everybody. They all go through these ups and downs and these cyclical natures where business is bad and they restructure. You look at how many times AT&T has transformed itself over the past 70, 80 years. It's remarkable, right? Look where they are today. So let's see, because what Genia just said, I want you to understand when she said, when you're looking at stocks, don't base it on everything going on in the past. When I look at a company like Ford, that's why when I say or I tweet about Ford and why I like it, I love the fact that people are like, oh, Ford is terrible. And, they're not selling. That was the past. The stock's down 50% from its highs. A lot of that is priced in. What they don't realize is how much money this company's been investing in technology over the last 5-6 years, how much hidden value and billions of value they have in these technologies. The electronic vehicle, not too happy to use the Mustang name for it, but it looks pretty cool. And you're going to see Ford transform itself. There's a lot of businesses that operating overseas that are starting to turn positively. So, when you look at Ford right away, when I look at Ford, I'm like, oh, Ford, you got to be kidding me. F-150. Yeah. What else you have? Well, they're not going to really be selling cars anymore. They're selling SUVs and trucks because that's what's selling. So they see the risks just like we see the risk, but they're transforming it. And when they do, a lot of times you'll see Ford, which is whatever, close to 9. It'll be like 12, 13, 14. Everyone, all the technical traders start loving it, and then you start getting into it. But it's great to do the homework now to see what's going on. And, when I look at a company like Newell, it's, I want to look at a fresh pair of eyes and say, okay, what does Larry Robbins see with the stock? What does he like about it? And forget about the past. We know it did a terrible job in the past. That's why it's down so much. Soros was buying Peloton. I thought that was interesting. A couple of people buying Peloton. Again, people thinking Peloton IPO, it's going to get destroyed, recent IPO. It's just, but everybody here that uses this service loves it. They think it's fantastic. They're generating money. They have lots of products, and people, everybody I talk just rants and raves about it. It's kind of crazy. I want to dig into that a little bit more. David Tepper, who's probably my favorite hedge fund manager, is someone who always has a pulse in the market. This is really interesting, guys. He took new positions in Alibaba, Avago, right? 2 new technology positions, and added to his positions in Facebook, Google, Micron, and Adobe. He doesn't have a ton of positions. But this tells me Tepper thinks the market is going much, much higher from here. These are pure growth names, not value. These names are not going to go higher unless the market goes higher. They're going to be driving each other higher, right? But you're adding to these positions and just starting a new position in Alibaba and Avago. Also bought more PG&E, which I said earlier, right? The symbol for that is PCG. 2 big fund managers buying a really piece of garbage company. At least that's what I thought. That's probably what you thought reading the headlines. I want to find out why these guys are buying. Where's the value that they see? I mean, you look at Snap. I told you about that. When I ran through this 13Fs, I told you about Snap that's got destroyed. And I said, there's 2 fund managers that are pretty reputable at buying it, and that stock is up a ton. Again, you don't want to look at the past. You want to look at the future. Why are these guys buying it? What are they doing to change this perception that's going to result in higher earnings, or they're going to beat expectations going forward with earnings and sales, and that's what's going to drive the stock higher. But Tepper also sold out of, the cyclical names, like Exxon's, a couple of healthcare names, Humana, United Health, which was interesting. He really believes that this market's going higher. That's his sentiment right now. And he has had his pulse on the market. I would challenge. I think he's got one of the best performances outside of the algorithm trades, which front run the markets, but incredible performance, just always ahead of the markets. And that was interesting. Tiger Global also increased their position in tech. Alibaba, Facebook, these are new positions, and they maintain their position in Microsoft. You look at Carl Icahn, took a huge position in Hewlett Packard last quarter. Pretty good timing, right? You can say, hey, the guy still got it. He's great. He did have Occidental Petroleum, which came down a lot, which I'll talk about in a minute. But we all know what happened with Hewlett Packard. Xerox offered to buy the company a couple of weeks ago. The stock shot up about 15% this month alone. But it's still down 15, 20% from its 52-week high, which is probably why Hewlett Packard is saying, no, this offer is not good enough. Our stock was already trading higher this year. So they didn't do the deal, but that was a nice pop in that name. Good job by Icahn. Seth Klarman, Valpers Group, increased his position in CBS. That's a name I want to look at more closely. I hear great things. It's not the only person I know who's buying CBS. A couple of other analysts told me that they like the stock as well. Nuance Communication is a new position, symbol NUAN. This just broke out. This is a position I'm familiar with. I recommended in the past and did very well on my newsletters. So Nuance provides the voice recognition technology for a lot of the main players out there. Right? One of the best in the industry, if not the best. And what does that mean? Look at voice technology. You buy a new car, it has the voice technology in it. Appliances, voice technology. Virtual assistants, voice technology. Everything's turned into your voice recognition. Still a small company with a $5 billion market cap, trading at just 15 times forward earnings. Strong balance sheet. Expect to see strong growth going forward, but it's an interesting play. Again, it just broke out from a technical level. Occidental Petroleum. I mean, this is a name I hated and told you to get out of when they decided to outbid Chevron. That's like a tiny company outbidding Apple for something. To the point where Chevron's like, you want it for that price? You got it. You don't outbid the big boys. Companies that are 6, 7, 20 times larger than you. You just don't, right? If you're outbidding them, you're probably going to pay more than you bargained for, a lot more than you originally wanted that purchase for. But they bought Anadarko for $38 billion. And the big news, they got financing by Buffett, who basically got the deal of a lifetime and raked these guys. And I told you to avoid all this name at all costs. And the stock's down probably around 50% since April. Now, a lot of this bad news is priced in. You know, the stock did get hammered. I want to take a fresh look at it. Why? Because there's a few fund managers I saw purchasing this stock. It's an oil patch. Everybody hates oil. Oil prices have declined over the past couple of weeks. It's been a depressed industry. These names have gotten murdered. Nobody wants that. They want growth and technology. But this includes Buffett, which is not part of the financing, but he bought 7.5 million shares last quarter as a new position. We also had a director that made a large purchase as well on that stock. So again, why is it? Why are they getting into it? I want to learn, what's going on. Keep your eye on it. Maybe oil prices go to $50 and this thing falls another 15%. Now you're getting it at a discount to where Buffett got in. Getting a discount where some of these insiders have gotten in. That's how you play this. This is the best way to play it. Yeah, Viking Global came out, increased their position in Square, which has gotten nailed over the past few months. So that was interesting. And it was a big increase. They own 2 million shares, and now it's over 10 million. And now if you notice with that stock is trending higher. It's pushing 70 again. That stock was almost pushing 100. This is one of the ones we have in our portfolio that we're up on. We're up a lot more on it. But this is nice to see. They also doubled their position in Netflix, which I thought was interesting, right? Oh, everything about Disney's going to kill everybody. Well, not necessarily. I mean, there's a very good analyst that covers this industry that said that not only has he not seen declining subscriber trends through Netflix, but they're actually adding more subscribers during this time period where it's been pretty much a week since Disney has launched its Disney Plus service. I thought that was interesting. So when I'm looking at this and bringing it all together, guys, it's not like, wow, Seth Klarman purchased this, Bill Ackman purchased this, I'm going to buy it. It's a good starting point to find new ideas. Like Carbonite, I want to start researching. PG&E, I'm going to start researching. Just names that I'm like, wow, these guys are really buying this. Or maybe they're all dumping a certain name at the same time, which you could see, whatever. It's a lot of healthcare names are being dumped since it's one of the most heavily owned sector in the entire market, right, from all funds. So you're seeing a couple, just like David Tepper, dumping some of these stocks. Let's see how that impacts. But for me, I want to look at some of these names, especially ones that they bought that are down tremendously. What are they seeing now? And just, start doing the research, start doing the homework, and you're going to maybe find some short-term catalysts that can really drive the stock. Expectations are really low. If you're looking at the analyst estimates, with Target, the estimates were so freaking high, but they still blew by them, and the stock took off, which is amazing. But a lot of times when you have those high expectations, you kind of report inline earnings, and that stock will fall 5-10% because it ran up 30% into the quarter. So there's a lot of ways to play this of what I want to see. And it's just, for me, again, I'm throwing a lot at you guys, a lot of different ideas, and just how I'm looking at this. I'm just freestyling here. But this is one of the best ways to find new ideas. And most important, you could find these 13Fs pretty much for free. Just go on Google, type in 13Fs, and there's numerous sites that'll come up, and you can see what these guys are buying and selling after every quarter. And they report pretty much at the end of earnings season when all these 13Fs are released. So, guys, that's it for me. One last note here. We are launching our first new service in 18 months, which is Rich Suttmeier's 2-second trader, where not only is he going to provide a trade for you every single week, we actually have the system and testing it, and it's awesome, where it's going to allow you to put your own symbols for your stocks to go in there and use his algorithms and his proprietary system to tell you if it's a buy or sell or a hold. We have this technology on our site now. We're just beta testing a little bit right now. But we're going to launch this product probably within a couple of weeks. We're right there making sure everything works properly for you. This way you guys have the best experience. Very, very excited to launch this product. It's going to be awesome. If you want to look at Rich's performance, guys, for free, go to Curzio Research. You can look at Chart of the Week, and you're going to see how good this guy really is when it comes to individual trades. That's going to be behind our paywall now. So we're really excited to launch this service. Again, first new service we'll launch in 18 months. Very, very excited. And everybody's working real hard to make that happen. And it's going to come out in a couple of weeks. So guys, that's it for me. As always, thanks so much for listening. I'll see you guys in 7 days. Take care.
The information presented on Wall Street Unplugged is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility. Wall Street Unplugged, produced by the Choose Yourself Podcast Network, the leader in podcasts produced to help you choose yourself.